Hello and welcome to today's premium account market update, where we cover the ASX top 2050 for the month of June 2020. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances, and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, Managing Director of Investor Signals. I have over 24 years of experience in the financial services industry and a licensed securities and derivatives advisor. The topics for today's webinar: we look at the macro update driving equities. We roll through the ASX top 50 stocks with a focus on FY 20 and 21 earnings outlook. We look at the technical trends, portfolio allocations, and conclude with a short-term Australian market outlook. The Investor Signals broking account service is based around our model portfolios, which are an algorithm-driven strategy for identifying momentum in blue chip stocks. We run two strategies: the Australian equities, which is a focus on ASX 100, and the United States equities, which is a focus on S&P 100 in America. The 5-year average returns of the models are up on screen there, and the year to date at the end of April there. We've obviously had an ongoing recovery in May. We'll publish the May performance data in the next week. The Investor Signals broking account service includes access to our model portfolios, which cover the ASX top 20, 50 and 100, also the US S&P 100. We operate an ASX and US high conviction portfolio, which picks up the ideas expressed on the blog and in these recordings. We also have a ETF iShares model portfolio, which is a global strategy using exchange traded funds. Now, within that broking account service, we also operate an independent portfolio where we can work in partnership with you to execute ideas or strategies that we jointly agree on, and those can include derivatives, which may be something along the lines of a covered call to enhance the cash flow from an existing or from a stock position that's moving predominantly sideways in the market, or it may be buying call options as a replacement to being long stock, or selling or buying put options for protection. So we can do a variety of different derivative strategies inside that same broking account. If you're interested in opening an account with Investor Signals, please contact me on 1300 614 002. The Investor Signals website, the homepage, shows the three products that we provide, which is the research service, which is access to the Investor Signals member area, which provides a combination of charting, model portfolios, research advice on buy-sell ideas, and that's $1,320 for the year to subscribe to that. The brokerage account service, we operate that where we do our brokerage for you at our institutional rate, so we make no markup on brokerage. It's a management fee model with a performance incentive, and again, if you'd like to know more about that, contact the office, or we have a managed fund, which is more of a set and forget approach. The technology that I'm using in today's recording is the Investor Signals member area, and as I mentioned earlier, you can sign up for that for $1,320 for the year, or you can visit the Investor Signals website and establish a free trial, or if you're ready to sign up again, just give the office a call. Starting today with the XJO. Now, the US market, in particular the Nasdaq, has rallied back and recaptured most of the sell-off from the March period. The Australian markets lagged behind a little, but we are getting now into an area where we're approaching overhead resistance, which is just a valuation issue. And as we go through the stocks today, we'll have a look at where were the banks at the end of last year and where were the resource names, the leading resource names at the end of last year. The problem that the Australian market has is we're not going to get back up to those prior highs unless we get participation from the Australian big banks. And as we go through today's recording, I'll talk a little bit more about some of the issues that the banks face. But we're of the view that we're getting into a level that between sort of where we are at the moment at say 5,900 points up to maybe a maximum of 6,300, the market as a minimum consolidates and moves sideways, or maybe pauses and has a little bit of a correction. Now, that doesn't mean there's not buy opportunities in the market, and we're going to focus on the difference between the stocks that should be in portfolios and the stocks that shouldn't. So to do that, we go into the watch list, we select the ASX top 50, we organise it by percentage gain at the top. We arrange this so we're looking at buy signals first. So in today's recording, we're going through the ASX 50 stocks and we're filtering them by stocks that are under buy conditions, and then as we move through the list we'll get a switch from buy conditions into stocks that are under sell conditions, and that's a reference to the algorithm model that we operate. So for buying opportunities in the market, we focus on the buy side signals, and let's move through these. So Fortescue, our preference is BHP and Rio over Fortescue, but Fortescue's been under buy conditions here from around 660, now trading 1390. Newcrest is an opportunity in the market for investors to consider this week. At around $30, Newcrest looks good value. Gold has all the right fundamentals for it to continue to rally. Buying Newcrest at $30 is an opportunity that investors can act on. Look for a rally back up towards that 35 level as an opportunity to take profit. Woolworths, again, we see this as a high conviction opportunity in the market. Buying Woolworths at these levels or setting up a derivative strategy to profit from Woolworths having a rebound from these levels, but we see this as a high conviction opportunity in the market and one that investors should be taking action on. Oil Search we're a little bit cautious on. The problems that they're having with negotiations with the Papua New Guinea government just give us reason to avoid this name. I think Santos is the better choice in the market at the moment. APA Group back up against resistance. We really like the fundamental story here with APA, but the valuation's now fully captured in this 1160 share price. The company last year grew earnings at about 6%. It's a good yield contributor portfolios, but we'll wait to buy it on a pullback. Ramsay Healthcare, so again, we like this name. It's in the model portfolio. All of these names that are under buy conditions mean that they're in the top 50 or the top 100 model portfolio. In this case, we're looking at the top 50, so they're the top 50 model portfolio. Ramsay Healthcare, flat earnings this year due to the issues with elective surgery being cancelled. As that gets reinstated, Ramsay Healthcare will return back to normal conditions. If we look at the business, it's really traded sideways now for the last 4 or 5 years, and I don't see that changing. However, as we get into the back half of this year, I could see an environment where Ramsay could re-accelerate and move back up into that $70 to $80 price range. But so at around 70, it's full value for the moment. At 60, would be a high conviction buyer of the business. Coles we like Woolworths. Our preference is Woolworths over Coles at the moment, which is interesting. A number of analysts see it the other way. They see Coles as better dividend support and better opportunity for earnings growth, but risk reward, we like Woolworths. But in saying that, they're both obviously very similar businesses, but we just feel that Woolworths accelerating off that 34.50 probably has more of a short-term upside opportunity. In the case of Coles, from $15 bounce back up to $16 and then sell covered calls and enhance the return. You're getting about 8 to 10% income on an annualized basis from the dividend and the call option income over both Woolworths and Coles. Cochlear we don't mind. Encouraged that they had no problem shoring up their balance sheet with the capital raising there at $140 a share. The stock since then's moved from 150 back up to 190. Consolidates, but the longer term fundamentals for Cochlear we think are good. The stock's a little bit on the expensive side. Rio, so this is our preference within the iron ore space. Owning it at these levels, selling covered calls delivers, gain up near that 10% cash flow on an annualized basis, but Rio should track sideways around that sort of $90 to $100 level. ASX, so this has been one of our preferred asset allocations. It's in our high conviction portfolio, but we are looking to trim it this week at around around $88 to $90. The stock's starting to look pretty expensive, especially in an environment where transaction volumes are starting to fall off just a little. Um, so taking some profit there. The long-term fundamentals are still attractive, but just on a valuation basis, getting a little expensive. QBE, we just struggle with the insurance names at the moment, especially QBE's exposure in the US. Dexus not doing there at present. Lendlease, we like the fundamental story here, but there's a few things that have to go right over the next 6 months with Lendlease. In particular, the disposal or the sell down of their engineering business. I don't think that's really been finalised at this stage, and some of the property settlement issues that they're going to face over the next 12 to 24 months is probably a drag on the business. The stock's corrected from 20 down to $12, so a lot of that bad news is priced in. And longer term, the pipeline of development that they have is substantial. And one of the projects is the $21 billion of housing they're building for Alphabet in the US. So we like Lendlease. We just recognise that the issues that the economy faces over the next 6 months just makes it a slightly higher risk proposition. Insurance Australia Group, we were buyers of this at lower levels. We've taken profit at the moment. It pulls back probably not much below $6. We think it trades sideways and then can accelerate back higher from this sort of 550 range at the moment. So it's one that we're comfortable focusing our attention on. Santos, within the energy space, this is the one we like. If energy prices and Santos pull back a little bit and it retests around that $5 level, I think it's a buying opportunity, and there's a space for Santos in portfolios. BHP, like Rio, we're comfortable with this. I've just highlighted that if we see BHP back at this $32 level, that would be where we would like to add to the BHP position again. So just to have a think about that. If you don't hold BHP at the moment, a pullback to around that $32 level, you want to add that in. Mirvac not doing there at present. Orica, again, comfortable here. The company had no problem with their discounted rights issue. The balance sheet's in good shape. The mining industry in general is holding up quite well in a tough economic environment. Orica at around $17 should get well supported. The stock went ex-dividend last week, but otherwise we see it sort of staying up sort of within that $17 to $20 price range. So if we have a look at where the banks were coming into this, and this feeds back into that view on the XJO, can CBA get back to this $80 level, which is really what's needed to see the XJO get back up and retest those old highs. We think the next 6 months for the banks is a difficult period, so for that reason we can see that overhead resistance on the XJO remains, and the Australian banks may have further write-downs that they'll need to disclose as we get into that July-August period. We're coming into an interesting period for the market where the June earnings results in the US will be reported in the first and second week of July, and that'll really give investors a pause to really reconsider the full impact of this COVID lockdown period on corporate earnings, and it's going to be a bit of a reality check for the market. So happy to just remain a little bit cautious on the banking stocks as we get through the next 8 weeks. Sydney airports, again, difficult to get visibility on earnings, but longer term we see this recovering. So at around this sort of 550 level, keep an eye on that as a buy on the dip, especially if we get a little bit of risk off pickup in the market. Sonic Healthcare, this has been one of our preferred recovery plays in the market, but at around $30 it's full value. Again, over the next month, if we see a pullback and a retest of sort of anything back down around 25.50, you want to look at adding that into your portfolio. Now we switch into, CSL. So we like this name. This is one that you want to put on your watch list. Not very often we see a correction here. The collection within the blood collection side of their business is obviously going to be impacted over the last quarter or so. We'll look back and recognize that this probably creates a good long-term buying opportunity for CSL. So then the question is, how deep's the correction? I'll flag that sort of around 265 you want to start thinking about being a buyer of CSL. The channel might get down to sort of 240, so something within that range. If there's more substantial impact to earnings and we're not seeing that sort of growth of 10%, at least that the market's relying on to justify the valuation, you could see CSL back down around 225 later this year. That's not our base case. We think we're more likely to see a bounce off that 265 level and a rally higher. So we're wanting to look at both call options as a derivative strategy and just accumulating the stock. So continue to read the blog and I'll update you on that. NAB, with all the Aussie banks, the story's the same, and that is we're just a bit cautious as to what the next 3 months hold in store for the banks. Same with Westpac. So Ampol's the old Celtex business that's been rebranded. This was always a recovery opportunity as people return back to work. Sentiment around normalisation in the economy created a buying opportunity here. There was that takeover bid on the table at $34. That's been cancelled for the moment. But up at around $27, you would think that the stock's probably full value for the moment until we get more visibility on the earnings picture. But again, a buy on the dip opportunity there in Ampol, and I'll keep you posted on the blog. Medibank, so now we're focusing on stocks that are under sell conditions, so we don't have Medibank in the portfolio. We think it's up near resistance there. Brambles we've liked, so we've had a number of stocks in the last week that have switched from buy conditions to sell conditions, which means they've been removed from the model portfolio. In the case of Brambles, up against resistance there at 11.50. We don't see too much downside in Brambles though. Likewise in AZJ, up against resistance, but again don't see too much downside there. Telstra just switched to sell conditions on Friday. The dividend of 16 cents per year is supported by a combination of underlying earnings and the NBN payments. The issue Telstra has is that it's a low growth business and there's not much headroom to increase the payout ratio. So therefore the upside to shareholders is growth around 5G and the potential that in 18 months time they separate the infrastructure side of the business away. But for investors seeking income in this environment, Telstra is a fairly low risk proposition. Goodman Group, so this has been our preferred property trust. Their exposure to logistics centres makes an attractive long-term thematic, but at $15 it's full value running in a resistance. Wesfarmers, now under sell conditions, $40 captures the full value for the stock given the lack of earnings visibility. Origin, we like the business, we've been buyers of it, but now it's switched to sell conditions at around this $6 level. It's full value. Stockland's up against resistance at 350. Amcor, again, great business, right sort of product mix in this environment, given that a lot of the earnings come from packaging around food and consumer staples, but at around $15 it's getting expensive. We came into this COVID period with low levels of earnings growth within the Amcor business, supported by cost synergies from the Bemis acquisition. It's now up against resistance. We'll take a look at it if we get a pullback over the next month or two. Suncorp, up against resistance, pretty cautious there. I don't think Suncorp's taken enough of a write down within their banking business. AGL Energy not doing their undersell conditions, Vicinity undersell conditions, Woodside Petroleum now up against resistance there and undersell conditions at $22. Transurban, we think the recovery's bounce is completed here at $15. The stock's too expensive given the lack of earnings impact visibility from 2020. Dividends likely to be cut to some extent. So shouldn't support a rally straight back to $16, so back against resistance where it is at the moment. South 32, overhead resistance just above $2 there, so preferences BHP and Rio go for quality. And the top 50 index sits with our view on the XJO that we're now up against resistance level in the index. Macquarie, one of our preferred recovery opportunities in the market, but at around $110, it's back up against resistance. And I'll cover more about Macquarie on the blog over the next week or two. Qantas switched to sell conditions, so you're starting to see a number of stocks just in the last week that have switched back to sell conditions. Computershare, comfortable with that on a fundamental basis, that at around $13-14 it really does capture the recovery, so back up against resistance there. It's switched to sell conditions, so cautious there on Computershare with a valuation just a bit rich. Likewise with James Hardie, we've seen good new home building statistics in the US, which have supported a recovery in some of these housing construction stocks, but at around $27 James Hardie's full value, but it is a high quality business that should start to grow earnings over the next 12 to 24 months, so we are looking to buy that on a pullback. And likewise with Boral. Treasury not doing there at the moment. GPT back up against resistance, and we just want to see more visibility on earnings. Aristocrats now shifted to sell conditions. ANZ under sell conditions, so flag resistance there. And if you're looking for a banking stock to short, sit on the short side of ANZ with a stop loss if it breaks back above that 1950 level. Centre Group up against resistance at 250 there, and there we are back to Fortescue. So there's a handful of stocks there to take a look at in the market this week. And to conclude with a short-term outlook, the XJO, based on the lack of visibility on the earnings around the banks and the resources being pretty close to full value, we see little catalyst to really drive the XJO too much higher. If the US market can continue to move, obviously it'll drag the XJO up higher with it. But the Nasdaq you're starting to see a bit of a rotation in the US out of technology into industrials and financials, at least in the early part of last week. Although by the end of the week you started to see the US banking sector, and I point to Citigroup as an example, where it closed down 6% at the end of last week, and that was on Friday night. So if the technology stocks are getting expensive and investors are rotating out of them and the US banks can't rally, I think it leaves an environment where the market at best tracks sideways or could be ready for a more substantial pullback. So that feeds into our view that you want to focus on Newcrest, Woolworths, Coles, healthcare stocks, and again follow the blog during the week to get closer insight into the ideas that we're taking action on in the market. Thank you for listening in, and again, if you'd like to trial the Investor Signals technology that I used today or inquire about a broking account, please visit our website or call the office. Details on screen. Thank you for listening in.